Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. Have you noticed that the mainstream financial media always seems to find a way to poo-poo gold and silver, no matter what is happening in the markets? If gold and silver are going up, well, it's overbought. You better get out now before it crashes. And of course, every time that gold and silver drop, well, the bull market is over and you probably should have never bought it in the first place. That seems to be the typical narrative on these financial networks. So check out this dumb headline that I ran across on CNBC yesterday. Quote, "The momentum trades of 2026 are breaking, with gold, silver, and South Korea down big." Dude, everything sold off yesterday, especially in early trading when this headline was generated. Stocks sold off, Bitcoin sold off, even treasuries sold off. And yes, gold and silver sold off too. I mean, I kind of wonder what people were buying. Oh yeah, oil. You know, I initially thought that defense stocks were probably going to be doing really well, but they actually sold off on Tuesday morning as well. So it was just a broad-based kind of a panic sell that you sometimes get when markets are trying to digest crazy things. And of course, an all-out war with Iran, that's a pretty crazy thing. It's a big deal, right? But the point here is that gold and silver being down was not the headline. Right? In fact, it's not unusual for gold to dip when stocks tumble because the metal can be quickly liquidated to cover short positions and margin calls. If you look at the early stages of a lot of stock market crashes, you will find that gold and silver also sell off as well. So that's not surprising, but there were also some dynamics in the markets that I think were causing some panic selling in precious metals. But what I'm driving at here is when you see big headline-generated moves in gold and silver, don't listen to CNBC. Remember the fundamentals, right? These big dips are often buying opportunities. So when you see something like a war, you have to ask yourself what fundamentally has changed that could impact the gold and silver market. There are some things to consider, but just panic selling probably isn't the wisest move, especially when gold is basically the last safe haven standing. And I think it's really interesting that treasuries have not gotten a bump from this geopolitical instability. I mean, you would expect bonds to really be doing well in a time when we have a lot of geopolitical uncertainty, right? Bonds were always considered kind of a safe haven bid. They're not anymore. Gold and silver are really the last safe haven standing, the big sell-off yesterday notwithstanding. So anyway, since we are at war now, and it doesn't look like it's going to end quickly, I thought it would be a good idea today to kind of walk through and talk about how gold has typically performed during times of war. But before I get into all of that, I do want to thank you so very much for listening to the show. I say this every week, but I mean it from the bottom of my heart. I know there's a lot of things out there to listen to. There's so much vying for your attention, and the fact that you spend a little bit of time each week with me, I thank you, and it means a lot to me. And if you would be so kind as to help us out, I would love to grow the show even more. And if you're finding value in it, other people probably will as well. So things that you can do to kind of help us that won't cost you a dime other than a few seconds of your time. Go to wherever you listen to this podcast. Give us those thumbs up and those stars and write us a good review. Those help boost the algorithms. And also, if you would share the episodes on your own social media channels and help put other eyes on them. If you would do that, I would say thank you. And I would very much appreciate it. So as I mentioned, pretty much everything dumped Tuesday morning. Stocks actually recovered a lot of their losses later in the day, and gold and silver both steadied as well. Silver gained back some of its losses. It actually dipped below $80 for a brief time, and it closed back over $80. But gold did not recoup any of its losses. The yellow metal closed just over $5,100 an ounce, which is basically where it was on Friday, February 20th. So it was a big dip, but keep in mind, we actually saw a pretty healthy gain on Monday. So it gave up all of that and a little bit more. Now, as I said, I do think there's more to this story than simply precious metals getting caught up in a broader market sell-off. I think there is some psychology in the marketplace that is starting to work against gold a little bit. And that's the notion that much higher oil prices will spark an inflation surge, and this is further dampening hope for interest rate cuts. And because gold is a quote-unquote non-yielding asset, typically a higher interest rate environment is perceived to be negative for gold. So if the Fed's not going to cut as much, then maybe gold's not going to rise as much. So right now what we have is a strengthening dollar, which kind of makes sense. That's typical in a high-risk environment. And we're also seeing this worry, oh my gosh, the Fed's not going to cut interest rates anymore. We're going to be stuck in this high interest rate environment, so therefore that's bad for gold, so we should sell gold. And, this once again underscores the complete misunderstanding of what inflation is. It's not just prices going up, right? It's an increase in the supply of money and credit. That used to be what we meant by inflation. And now we no longer mean that. When people say inflation, they really just mean prices are going up. So I guess it makes sense. Oil prices are going to go up. Oil has an impact on so many areas of the economy because energy is crucial for everything. So, this prices, when energy prices go up, they tend to get embedded in other products. So we could see the price of other products going up. So therefore inflation. But keep in mind that it used to be, and what we really mean by inflation is a broad-based increase in prices. The entire price level rises, not just some prices, not just most of the prices, but all of the prices. And again, inflation is the increase in supply and money and credit. One of the symptoms of monetary inflation is consumer price inflation. And when properly defined, inflation's been surging for months. So suddenly worrying that an oil price shock is going to cause inflation, and now all of a sudden we should be worried about gold, that's misplaced. If you were worried about inflation, you should have been worried about inflation yesterday and a week before, not just today, because it's not really about oil prices, it's about money printing. Now, again, that's not to say that rising oil prices won't have a significant impact on the economy, right? As I've already mentioned, energy is factored into the production of almost everything. So when energy costs go up, other prices tend to rise too. And, this war, if it causes a serious contraction in oil supply, it could be the spark that lights the fuse of another financial crisis, right? We've been talking about how we have this setup that's so similar to what we saw in 2006 or 2007 or in the run-up to the dot-com bubble. And I did an article just recently about how AI could be, the next catalyst for a crisis. Maybe this oil shock will be the next catalyst, or maybe not. That remains to be seen. But the inflation problem was here before the war, and the inflation problem is going to be here after the war. And in fact, the war is probably going to exacerbate the inflation problem because it is going to require more borrowing and spending. If you haven't noticed, the United States doesn't have any extra money laying around to have a war. So this is going to add to the deficits. It's going to add to the national debt, which is already unsustainable and a big problem, as I've been talking about on this show for quite some time. And, also forget, when we're talking about inflation, gold is an inflation hedge. Why are people selling their inflation hedge when they're worried about inflation? This makes zero sense. You need to keep that in mind when the goofy CNBC guy tells you to sell gold because inflation is going to heat up. It's not just about interest rates. And here's the real key. I don't care what inflation does. The Fed is going to end up further loosening monetary policy, unless you're telling me that the war with Iran is going to eliminate the debt black hole. Remember, I've been talking about this for well over a year now. The Fed is in a catch-22. It simultaneously needs to cut interest rates to deal with this economy, to deal with the debt black hole. This debt-riddled bubble economy cannot function in a normal interest rate environment. It has to cut. That's why everybody's begging for cuts, and that's why I'm convinced they're still going to cut even if there's an inflation issue, no matter what everybody today is saying. So, unless you're telling me that the war with Iran is going to eliminate the debt black hole, I just don't see this as being necessarily this big, hold up for looser monetary policy. I think we're going to get the looser monetary policy anyway, inflation or no. So, I know this isn't a foreign policy podcast. It's not a politics podcast. And I definitely don't want to get into the ins and outs of the decision to attack Iran. But I do want to take a quick aside and read you something that James Madison wrote about war. Because whether you think attacking Iran was absolutely the right move, or if you think it was just another foreign policy blunder, these words are worth considering. Madison wrote, "Of all the enemies to public liberty, war is perhaps the most to be dreaded because it comprises and develops the germ of every other. War is the parent of armies. From these proceed debts and taxes. And armies and debts and taxes are the known instruments for bringing the many under the domination of the few. In war, too, the discretionary power of the executive is extended. Its influence in dealing out offices, honors, and emoluments is multiplied, and all the means of seducing the minds are added to those of subduing the force of the people. The same malignant aspect in republicanism may be traced in the inequality of fortunes and the opportunities of fraud growing out of a state of war, and in the degeneracy of manners and of morals engendered by both. No nation could preserve its freedom in the midst of continual warfare." No nation can preserve its freedom in the midst of continual warfare. In other words, war has consequences, whether it's necessary or not. And a wise person always considers the possible unintended consequences of any policy decision. As the French economist Bastiat put it, a good economist considers both the seen and unseen effects of any decision, both the obvious and the not so obvious. Unfortunately, we have a lot more partisan hacks out there than we do good economists. Most people are merely concerned with selling the policies of their side and tearing down the policies of the other side. And this results in a lot of sweeping potential negative outcomes under the rug. Don't do that. Endeavor to be a good economist. Consider both the seen and the unseen. Think about the potential good outcomes and the potential horrible outcomes in any policy decision. Consider possible blowback. If you do that, you will better position yourself to navigate all of the craziness that tends to pop up as we march into the future. So I'll hop off of my soapbox now. Let's talk about gold. We're in a shooting war with Iran. How might a protracted conflict impact gold prices? Well, the historical pattern since the 1980s suggests that beyond an initial safe haven bump, a war alone doesn't seem to significantly impact the trajectory of gold prices. As wars drag on, other factors tend to step in and drive the market, particularly monetary policy. So we saw that safe haven bump on Monday as markets digested the onset of hostilities. Gold briefly traded above $5,300 an ounce. Silver was also up big on Monday. However, I guess overnight, everybody kind of thought about what was going on. And by Tuesday morning, the yellow metal was already giving up all of those gains due to dollar strength. And as we've already discussed, a growing sense that the Federal Reserve will hold interest rates higher for longer. Now, since the 1980s, gold has typically gotten the biggest boost in the run-up to hostilities, not during the war itself. For instance, during the long buildup of forces in the Middle East during Operation Desert Shield in 1989, gold gained 15 to 20%. And then there was another spike of around 10% when the U.S. actually launched its offensive with Desert Storm. Similarly, gold got a brief safe haven boost in 2003 when the U.S. invaded Iraq for the second time to topple Saddam Hussein. We saw a similar pattern when Russia invaded Ukraine. The yellow metal surged to above $2,000 an ounce at the onset of the war. But underscoring the fact that gold's wartime performance is heavily influenced by other factors in the economy, the launch of the war on terror after 9/11 drove a very different scenario. After the the 9/11 event, the gold price briefly collapsed as a liquidity crisis gripped the markets. So ultimately, we see this safe haven boost, but war tends to quickly lose its grip on the markets. And while wars and rumors of wars tend to cause the gold price to spike, war momentum has faded quickly in the modern era once hostilities commence and markets get a feel for the likely trajectory of the war. And at that point, other factors such as inflation expectations, interest rate policy, dollar strength or weakness, and the general state of the economy tend to have a more impact on the gold market. So this suggests it's not so much that war drives the markets, but the uncertainty that surrounds the possibility of war that sparks those initial gold rallies. Once war is in play, these other factors step to the forefront of the markets. So depending on those factors, the price of gold can move in any direction as the war moves on. So looking at some of the past conflicts, 1 year after Desert Storm, gold had given up all of its pre-war and early safe haven gains. Now, of course, it was a pretty short war. It was over quickly, but gold was kind of in a bear market after that. However, during the wars in Afghanistan and Iraq, War II, which were, of course, a lot longer, gold was in a 10-year bull market. But it wasn't driven really by the war. It was driven by Federal Reserve monetary easing that led up to the 2008 financial crisis, and then the 0% interest rate era and the quantitative easing era of the Great Recession. Between 2001 and 2011, gold surged from $250 to over $1,900 an ounce. Russia's invasion of Ukraine in February 2022 roughly corresponded with the Federal Reserve's war on inflation. So during that conflict, we've seen gold go both up and down. Of course, we're still in the midst of that war. The Fed bumped interest rates up for the first time on March 16th, so just a few weeks after the invasion. And then we had subsequent rate hikes, and the gold price quickly unwound and erased the early war gains that we saw. By October of 2022, the gold price was below $1,650 an ounce. But of course, since then, we've had this massive rally where we now have $5,000 gold, all of which, of course, took place during this wartime. So kind of if you look at the big picture, in the modern era, the price of gold during wartime seems to be driven more by economic and monetary policy than by battlefield headlines. Now, that's not to say the gold price doesn't react to war news at all, right? We will almost certainly see increased price volatility as war news comes out and markets digest the latest headlines. However, these price swings, even though they're going to be deep at times, they tend to be short-lived, right? You have to pay attention to those fundamentals. What's going on underneath the surface, below those war headlines? Because it's clear that war alone didn't solely drive gold's largest wartime moves in the modern era. The biggest gains were due to a combination of war plus monetary response. So since the 1980s, gold has performed best during protracted conflicts coupled with aggressive monetary easing, negative real interest rates, and growing government debt. Now, of course, these are factors that are pretty much inherent in all wars. This is kind of what war does, right? You end up with monetary easing and negative rates and growing government debt because you got to fund the war. War is expensive. As James Madison reminded us, war is the parent of armies, and from these proceed debts and taxes. So yeah, war tends to drive debt higher. Central banks are often forced to drop interest rates and run quantitative easing programs to support government borrowing and spending during the drawn-out war years. As I've already discussed, this is by definition inflation, right? The war with Iran doesn't look like it will wind down anytime soon, although war is hard to predict. It could be over even before I'm finished recording this. But keep in mind, this conflict was launched as the economy was already being dominated by a debt black hole. Despite recent bearishness on the possibility of rate cuts, this debt-riddled bubble economy cannot function in a normal interest rate environment. I know I've said that once. I said it again, and I'll probably say it again. I might even say it again before the show's over, right? This is a very important thing to understand because we've seen this battle between the rate cutters and those who want higher interest rates. We can't avoid this basic fundamental issue, debt. Debt and high interest rates don't play well together. So there we are. More cuts are almost certainly on the horizon, although we are already in an inflationary environment. If the Iran conflict resolves quickly, it won't likely impact the trajectory of gold. However, a long, drawn-out conflict could create a Vietnam scenario with impacts reverberating throughout the economy. War spending, coupled with the war on poverty in the 1960s, drove borrowing and spending that set the stage for the stagflationary decades of the 1970s. The underlying economy is arguably shakier now than it was then. So, to borrow a phrase from Pink Floyd, Iran could be just another brick in the wall. But the bottom line is, you've got to keep your eyes on the fundamentals. Yes, the war adds a new element to the equation. We definitely have to watch what's going on. There'll be important announcements, important things will happen. It's undoubtedly going to affect the oil price. You know, they've shut down the strait, and that means that oil tanker traffic is going to be limited. So there are ramifications here. But it's all happening within context, right? So we still have the debt black hole. We still have all of the malinvestments that have never been dealt with after the coronavirus and even the Great Recession. We still have all of these factors. We still have money printing. All of these things are still in play. So you have to consider everything. Don't tunnel vision just on the war when it comes to trying to analyze the trajectory of gold and silver. So that's basically that, right? The war itself probably isn't going to have this huge impact on the price of gold, but it is going to play into all of the other dynamics. So, just keep watching, reading, follow us at moneymetals.com/news. And, as I said, I've been saying this for quite a while. No matter what happens, you're going to get inflation because the government's still got to print money. It's still got to pay for all of this government. Big government's not free. So you're either going to pay for it through taxes or the inflation tax, and it's usually the inflation tax. So we're always in an inflationary environment, and that means you need to have real money. That means you need to have gold and silver. Here at Money Metals, we can help you out with that. We have some pretty good specials running right now. If you go to moneymetals.com and just click on the specials tab in the navigation bar, it'll take you to that page. And one of the things I want to highlight is that we currently have silver coins, 1 ounce silver coins. These are sovereign coins like Krugerrands, and we have them at very low spot prices. So that's something worth checking out. And we also still have junk silver, talking about quarters that were minted prior to 1965. They contain 90% silver. And we have these at very low spots, and in some cases, even below spot price for junk silver. So check out those specials over at moneymetals.com. When you see these price dips, I still say that it's a good time to buy. They're buying opportunities, unless you think the bull market is over. And again, you need to keep your eyes on the fundamentals. I don't think there's any reason to think that the gold and silver bull market are over. So check those out over at moneymetals.com. So I want to wrap up the show by reminding you once again that it's probably not a good idea to take advice about precious metals from people who are deeply embedded in mainstream investment paradigms. I ran across a fun story last week about how the rapidly skyrocketing gold price has increased interest in gold prospecting. And this article was by USA Today, and they did this report about a guy. He lives out in Colorado, and he has a business where he takes tourists on gold prospecting tours. And he's even written a tour book, which apparently is selling really well right now because a lot of people are interested in gold. I mean, who wouldn't be, right? You see $5,000 an ounce gold, you think, it'd be great to have some. Well, leave it to USA Today to turn a fun story about gold into a diatribe about how gold isn't really worth having. I'm not kidding. Our intrepid USA Today reporter found and interviewed a finance professor, and that spun this fun story about gold prospecting into a report on the reasons serious people aren't looking for gold. In fact, according to this story, they're cashing in and selling it. Look, I get selling gold when you need to make ends meet. I even understand taking some of your gold gains and doing something nice for yourself, right? Sell a 1 ounce gold coin and go on vacation. Makes perfect sense to me. What I don't get is selling gold just to make a profit, right? You see the gold price is up, so you sell your gold because you want to book that profit. You're literally trading good money for bad. And, if you hang on to those dollars that you got for your gold, they're just going to sit there and lose purchasing power. So I don't see the point. Unless you're going to buy something, don't sell your gold just to make a profit. That's my opinion. I mean, you do you, right? But that's how I view it. So USA Today brings in Peter Riccuti, and he's a finance professor who thinks that buying gold is dumb. Now, quite frankly, I think mainstream investment people who think gold is dumb are dumb. So there's that. But anyway, Riccuti said he, quote, remains mystified why people buy gold when the economy feels shaky. He said it's all about the insecurity of the global economy. It's a fear factor. What? The dude just answered his own question. I mean, does our intrepid professor think those fears are misplaced? Does he think there's nothing to be afraid of? I mean, I suppose he hasn't been paying attention to the unsustainable national debt, the aforementioned money printing and inflation, the weaponization of the dollar, de-dollarization, the massive stock market bubble. I mean, let's get real here. There are things in the economy that you probably ought to be afraid of, right? There are risks out there. That's why you hold gold. Now, USA Today noted that Riccuti used to run Louisiana's state pension system. Ah, a government man. Now we know why he doesn't think much of gold, right? Government people don't like gold because it is sound money. Gold restrains government. If you have a gold standard, it's very difficult to expand the money supply and allow for all of the borrowing and spending that governments love to do. You can't run a warfare and a welfare state with sound money. So therefore, they don't want sound money. They want to prop up the fiat system, and that means you got to downplay gold. So Riccuti told USA Today that he remains skeptical that gold is ever a good investment. He thinks you should just invest in, quote, shares of a good public company. Now, I've got no problem with investing in shares of a good public company. I'm not one of these people who says, don't ever buy anything but gold. That would be dumb too, right? Balanced portfolio. But just think about what this guy said. He doesn't think gold is ever a good investment. Now, go look at gold's gains over the last 2 years and draw your own conclusions. And while you're Googling on the internet, if you want a really fun activity, go look up Louisiana's pension system, and you'll get a sense of just how good Riccuti was at his job. As the saying goes, those who can do, those who can't teach. But Riccuti is typical of most mainstream financial advisors. They've been propagandized to hate gold for the reasons that I've already mentioned, right? Meanwhile, by telling their clients to avoid gold, they're cheating them. It's as simple as that. Some of these people should be sued for malpractice. At least that's my opinion. But the good news is, I guess, the tide seems to be turning, especially after Morgan Stanley CIO Michael Wilson said investors should consider abandoning the traditional 60-40 equity bond portfolio allocation and adopt a 60-20-20 distribution with 20% allocated to precious metals. Apparently, the Morgan Stanley CIO does not agree that there is never a good time to invest in gold. 20% allocation, that's significant. And I've talked about before on the show that if we begin to see the mainstream embrace this, if more of the Riccutis of the world kind of relent and start recommending gold, we're going to see a huge boost in marginal gold demand with a lot of new people entering into the market because, quite frankly, a lot of people don't have any exposure to precious metals at all. And most people that do have gold and silver in their portfolio, it's usually 1 or 2%. So just imagine if we double everybody's exposure to gold and silver. That's a tremendous amount of demand, and that's not getting anywhere near the 20% that Michael Wilson recommended, right? So, maybe people will start listening to the Riccutis of this world and, I don't know, listen to me or don't listen to me. Listen to somebody, but don't listen to CNBC because they're not giving you good advice. Don't do that. Again, if you want real money that will hold its value over time, you can get a pan and head over to Colorado and try to dig up some gold. Or you can give us a call at 800-800-1865, and we can get you some gold or silver without making you stand in a cold river. And we have precious metal specialists. They're eager to talk to you. They're great at answering your questions. They're very, very knowledgeable. They love to talk. They love to tell you how gold and silver can fit into your investment strategy. They'll help point you toward products that might be good for you. They'll tell you about different programs that we have. I know a lot of folks, they've seen this big spike in gold and silver prices. And they're like, man, I wish I could get into this, but I don't have any money. I don't have $5,000 to buy an ounce of gold. I don't have a bunch of money to dump into silver. Well, you can do it a little at a time. We have a great monthly installment program here at Money Metals. For as little as $100 a month, you can build a gold and silver portfolio over time. So you can check that out over at moneymetals.com/news, or give us a call at 800-800-1865. Talk to one of our precious metals specialists about it. If you don't like talking on the phone, you don't have to. You can go to moneymetals.com and simply chat in a chat, so you can type instead of talk. Or if you know what you want, just go order it. We'll send it right out to you. And if you want, we would be happy to store your gold and silver in our state-of-the-art bullion depository in beautiful Eagle, Idaho. But do it today. As I said, I think that these dips are buying opportunities. And war or no war, we still have inflation. We're going to have inflation. The government is going to continue to devalue your money because that's what governments do. So don't hesitate. Do it today. So that's a wrap for this episode of the Money Metals Midweek Memo. You can get more information about everything I've talked about on the show today and a whole lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, you can join 1 million plus other people and get on our email list. Of course, you can subscribe to the Midweek Memo podcast on your favorite platform. And when you do, you'll also be able to tune into our Market Wrap podcast that runs every Friday. There, you're going to get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold, silver, economics, and investing. So, again, thank you so much for listening to the show. I really appreciate it. I hope you have a fantastic rest of your week, and I will be back here to talk to you again next Wednesday.